What is NOI? What is it and why is it important? That's what we're jumping into today. Hey guys, welcome everyone. Today we have something very exciting. We are continuing with another addition to our real estate fundamentals library. For today's topic, we are going over how to compute one of the most important and fundamental of the real estate financial calculations, aka net operating income, also known as NOI. A property's NOI is the simplest and easiest calculation to quickly review a property's performance. But it is also a small piece of much larger equations and much more important equations to evaluate different aspects of a property's performance, whether that's a property in your portfolio or a property you're analyzing for a potential purchase. Additionally, NOI is a key piece when you're just looking at the financials, whether it's your income statement or your budget comparisons for the month. NOI is a key ingredient that is very important for you to take a look at. So for this simple 2-second equation, there is a ton of importance. And for that reason, we want you to have a great understanding of it from top to bottom. Hey guys, Nick DeAngelo here with Saint Investment Group. For those that don't know me, we currently have over 150 million under management and have an additional 100 million more that we are raising right now from investors. Here's a quick outline for today's video on net operating income. First, we're going to jump directly into the equation and the definition so that you know exactly what we're talking about, you understand exactly what we're going through, and you can visualize and understand for yourself. Then we're going to explain the importance of the equation and what it means on a bigger scale. Next, we're going to review other equations that are important to financial analysis of properties and portfolios and see how NOI fits into those calculations as a number that's plugged in. That will give you a very clear understanding of how foundationally important NOI is for you to understand and be able to calculate quickly. And to end, we have something really special for you guys. We are going to walk through 2 real-life financials so that you can see exactly what goes into an NOI in real-life properties with 2 different product types. One's going to be retail and one's going to be industrial, and these are multi-million-dollar properties, very high value, very high quality assets. So you're going to get an insider's look on those and what exactly a real estate investor and owner is looking at when evaluating their properties monthly. By the way, no one is doing this. No one is literally dropping their financials in front of you so that you can see exactly what's going on. So I'm very happy to bring this to you so that you can check it out and see behind the curtain so that you can learn more about real estate. I make these videos because I believe investing in real estate is the single greatest way to financial freedom. And I want you, the viewer, to have all the information and education you need on this subject. As a reminder, I'm not an attorney, I'm not an accountant, I'm not a CFP, and most importantly, every investment is different and every situation is different. So I highly recommend that you reach out to your financial professionals before making any investment decision. Definitely check with them, run your situation by them, and get their opinion on anything you're thinking of doing. To start, let's jump directly into the equations so that we can see it, understand it, and do some quick calculations on it. In its simplest definition, net operating income, aka NOI, gross operating income, minus its operating expenses. The result of those 2 is net operating income. First off, NOI is calculated annually. And for this reason, it's useful for estimating the potential revenue of an investment property. Whether or not you buy a property all cash, or you mortgage it, or any type of financing situation does not affect net operating income. Debt payments on interest and principal come after NOI, so those are not included in the calculation to land at NOI. Debt payments on interest and principal come after NOI, so those are not included in the calculation to land at NOI. When you start adding in things like debt service and depreciation, you start arriving at things further down the financial statement like net income and cash flow. There is a difference between net operating income and net income, but we'll get to that later. All right, as you can see, it's gross operating income minus expenses equals net operating income. It's that simple equation. That's it. That's the whole equation. Now, there are a million things that are added into this, but this is the simplest way to put this so that you can visualize it and understand it at its base level. Now, let's use an example so that we can complicate it slightly, but make it more realistic so that you can better understand what this equation would look like applied to an actual property. This example, let's use a small apartment building, for instance. Let's break out revenues further to make it more realistic. Let's say it's $20,000 in rental income, $5,000 in parking fees, and $1,000 in laundry machines. So that equals the $26,000 in total revenue. For this example, let's use a total operating expense figure of $10,000. Let's say property management fees are $1,000. Let's say property taxes are $5,000. Let's say repair and maintenance is $3,000. And let's say insurance is $1,000. That's a total of $10,000 for total operating expenses. So for this example, as you can see, $26,000 for income, $10,000 for expenses. What is NOI? It's 26 minus 10, right? So in this example, you have an NOI, a net operating income of $16,000. Boom, it's that simple. Easy peasy, right? You got this. Hopefully that example, just to see some different line items, will get your brain moving to see the general flow of what real estate financials look like. So what other expenses are included in NOI? Property management fees. Property management fees are incurred directly by the investor or the owner of that property, whether it's an entity, etc., and therefore are included into NOI calculations under expenses. General maintenance. Every rental property, no matter how old or how new, is going to have some degree of maintenance responsibilities ongoingly. These will include things like groundskeeping, plumbing, electrical work, basically any maintenance conducted on the actual property. These must be accounted for under expenses, and these are deducted from NOI. Whether there's a full-blown lawsuit on the property or whether it's just something as simple as an attorney reviewing a lease, these are legal expenses that are included under expenses and calculated into NOI. Utilities not paid by the tenants. These are things like the common areas, like the lights around a building that are not in any specific unit where a tenant would be responsible, but rather it's for the building-wide expenses. Other things you'll often see in there, water, you'll see some sewage and waste, even trash. These are all calculated as expenses and deducted from NOI. Property taxes. While property taxes can vary widely depending on what market you're in, city, municipality, etc., these are deducted from NOI. Insurance costs. Money spent on insurance is deducted from NOI. That's even if it's only occurred biannually or annually. That's an interesting list. But what about expenses that are not included in NOI? Let's take a look at those as well. In order for you to understand and determine what should be included in NOI as an expense and what should not be, here's the biggest differentiating factor. Costs that are specific to the investor and not necessarily the property are not included in the NOI calculation or the expenses in this section. Here's a list of things that are more specific to the investor or the ownership and less property related, so they are not included in the NOI calculation. Check it out. Mortgage interest, income taxes, leasing commission, debt service, property depreciation, capital expenditures, repairs for certain wear and tear items. But remember, does the expense have to do with the property or does it have to do for the investor? That's the best way to know. All right, so now that you have a better understanding of NOI overall and what makes up the different pieces of NOI, the question is, why is it important? Let's talk about that specifically. The 4 biggest reasons that NOI is important are the following. The first is that real estate has a lot of quick math built in. Why is that? Because a lot of initial real estate evaluation has to be able to happen very quickly. This quick pace where you can compare things like, what's the cap rate? What's the NOI? What's the vacancy rate? There's a few quick questions that if you're a seasoned investor, you can ask these and get a pretty good gauge of what the market's like, how this property is being run, and how you as an investor can understand the numbers on a bigger scale of what that means. NOI is one of those. The first is that NOI gives you a very quick snapshot of how profitable a property is. The second is that it gives investors a quick look at the potential value of the property. So if the property generates this much net operating income, that has value. Consistent, dependable income has value. That's why if you take the NOI and you plug it into, let's say, a cap rate calculation, you know a general value of that property. So that's very important. Next reason NOI is important is because it is an important plug number in many different, very crucial calculations when evaluating a property. So NOI is one of the first steps that you calculate when making these other calculations that build on top of that. And the last major reason NOI is important is because it's a very important number to lenders. So if you're trying to get a deal done, very often you have to keep your lender happy because very often somebody's got to finance the deal for you. So NOI is a benchmark metric for different lenders. It helps them determine profitability like we talked about earlier, and it also helps them as an equation to see how risky the property is. The better performing a property and the more profitable it is typically means a less risky investment for the lender. And lenders are not typically in the business of risky investments. So if NOI is so great and we want to maximize that on a property, how exactly do we do so? How do we improve the NOI of a property? Well, we now know that NOI is extremely important for anyone from lenders to you, the investor, and to multiple other equations when you're evaluating properties. So it's important to know the biggest levers that move NOI up and down. The reality is, because this is such a simple equation, there's only two things you can do to maximize NOI. You can either reduce expenses or maximize income on the property and bring in more revenues. Oftentimes, you can see a property that's just clearly mismanaged. It might be quote unquote value add. It might be something off market that you found and sourced. But typically mismanagement leads to both lower revenues and higher expenses. Starting with your expenses, high expenses can significantly undermine your profitability and reduce your net operating income. So the number one piece of advice is to have the experience and know whether a property's expense ratio is on or off for the different categories. That said, if you don't have that, there's some pretty good workarounds for this. The number one tip, if you don't have the experience to just kind of know off the cuff, is to find out what other comparable properties are doing in your market. So that means just look what's for sale. Call the brokers on the properties for sale and get the offering memorandum. Get all the marketing materials. Check what their numbers are and then compare them to yours. Keep in mind that their numbers are not going to be 100% accurate and typically are adjusted to make them much more favorable for a buyer to view, but it is a good way to peg and gauge the different expenses of a property that might be similar to yours. That said, if you call and get, let's say, 3 offering memorandums, you'll start to see some trends of what numbers should be and in what ranges. In seeing these other comparable properties, you might find certain things like your utilities are too high. That might mean a water leak. That might mean lights that are on outside more hours than they need to be. Or you might need to replace some LED lighting instead of your standard lighting. Or it might be that your property management is charging too much compared to others in the market. These are all really good things to know. Next is your income. The other way to boost your NOI is to increase your income on the property. Again, the best way for you to know if you're competitive in your market is to find out what the other comparable properties are doing in your market as well. Again, I would point you to the same source, which is calling brokers that are representing properties for sale local to you with similar size and similar features, and get the offering memorandums and check out their financials. The more you know your market, the more you know where you can compete, where you can beat your competition. So that might mean things like you give a couple weeks of free rent, but you have a higher price overall for your rent. It might mean that you have a higher vacancy than normal that you need to get under control. It might mean that your accounts receivable is too high and that's leading to a lot of drag and things like legal and issues there. And if once you get that income in, that it'll sort itself out. But here's a bonus for you. Rather than just looking at different ways you can compete on line item income, one of the best ways to boost income is to find new sources of income on that property. So if you're in the commercial space, let's say industrial, let's say retail, let's say office, etc., there's a huge boost to your financials by just using CAMs with your properties, common area maintenance fees. These are monthly fees that landlords assess to tenants to recoup much of their expenses or all of their expenses. If your property fits the bill for this and you're able to recoup some of your expenses, it goes straight to the bottom line typically. Other ways to find extra income in your properties: charge more for premium amenities, have laundry on site, charge for parking, charge for pet rent, etc., etc., etc. There are many ways to add extra streams of income into your properties, but this is one place where you need to be a little bit creative. And again, seeing your competition might give you some good insight to what others are doing here as well. Now, NOI is included as an important plug number for many other bigger financial equations. Let's take a look at some other equations that use NOI in the calculation. The first and most important by far is the capitalization rate, aka the cap rate. This is one of the most important financial calculations in real estate. And for that reason, we did an entire video on it. So check it out in the description below for the link and see that whole video just like this. It's a deep dive into capitalization rate. Cap rates are so important that they're in nearly every conversation about purchasing property ever. It's the quickest and easiest way to determine value, and NOI is one of the pieces of that quick equation. Super quickly, all cap rate is NOI over the market value or the sales price, whichever one in your instance. You take that number and you multiply it by 100, and that's your cap rate. The next calculation that includes NOI is debt service coverage ratio. This is most commonly used by lenders, and you'll see them throw around terms like DSCR. Lenders look at this equation to determine what NOI looks like in relation to the annual mortgage debt service. And this essentially shows the potential cash flow with debt included. And so for lenders, they want to see that you can pay your bill, and DSCR, the debt service coverage ratio, gives them a quick ability to calculate that to see where exactly you land on that scale. The next equation is return on investment, ROI. Another extremely foundational real estate calculation. ROI is just taking the NOI and dividing it by the purchase price of the property, then multiplying by 100 just to get the percentage. ROI is just another calculation for investors to understand the profitability of a property. The last equation we're going to go over is the cash on cash return of a property. This is an extremely important calculation, and this is one that investors most commonly use to see what their return is specifically on the cash that they outlaid on any given deal. This formula looks at the NOI in relation to the initial cash that an investor outlaid on an investment. While some of the other equations give you insight on the deal as a whole, cash on cash return gives the investor an idea of the return on the cash that they came out of pocket with. So it's very important for that because it's a different way to look at their returns. All right, I hope that helped going through some of the important equations that use NOI. So let's hop into our grand finale, which is taking a look specifically at two different properties' financials and seeing exactly how NOI is calculated on real life examples. All right, so let's start off with the first property. This is a retail property in Southern California. I wanted to start with retail because it's a lot more complex than our second example. It'll show you some different pieces that go into income and a bunch of different things that go into expenses. So this is the more complex of the two, so let's check this out. So the first thing you're gonna see here is the total rent. This is just what is collected, $45,000 for that month. Again, this is a good sized neighborhood center with multiple national credit tenants in there and some mom and pops. So it gives you a good example of like a C plus B minus level property in a certain market. Now here's something quick to notice. $95,000 as opposed to $45,000 to $95,000. That's how important all these other income sources can be on a property. It can over double the income of a property to have these other sources, particularly common area maintenance, aka operating expense reimbursements. So you can see that $95,000 is our final income number for that month. Next, we move over to operating expenses. You can see no real estate taxes this month, but they were assessed previously. That's a good figure for this property. Also, this property's been owned for a very long time, and this market that this property in has a tax increase ceiling, so it can only increase so much every year. So you're gonna see comparatively very low real estate taxes in this market as opposed to many other markets in the country. Just a quick note when you're looking at the annual column of the taxes. You're gonna see that expensive every month and utilities. So these are the recoverable expenses. These are things that we can pick back up in CAMs. So therefore do not come directly out of the landlord's pocket. That's very, very freaking important. Next, we're gonna move along. We're gonna keep looking through here. You'll see some plumbing, you'll see landscaping, general building repair. Here's a big one. You're gonna see security. That is really expensive. This is a monthly number. Can you imagine over $11,000 a month in just security? Look at this annualized number. So, well, there's a story here because this number's too big in relation to income for this to not have some big story behind it. The story for this property is that there's a lot of construction in the area, which is good. In this market, this construction is Class A apartments directly across the street. These beautiful, sprawling, I think it's 700 or 800 units of amazing Class A. For a retail center, that is a dream come true. That's a ton of people that are going to be going directly to your center that are high income, that can afford Class A apartments. The downside to this is there's also a large homeless issue in the city that this property's in. So with all that construction and with all those things going on, are also a lot of areas where homeless people can live within giant construction sites. So there's homeless people that are floating around constantly. And when those homeless people get moved out of that Class A apartment development, they go across the street to this property. Now, because of the homeless population, there's a huge boost in this property in vandalism, in broken windows, in things that directly affect the tenants' businesses and make them less able to pay their bills because of the damage to their business, the damage to the look of the center, and also with homeless individuals being difficult with clients and customers that are coming onto that property. So, our solution is to have security there to get them off-site to somewhere else. What that does is it allows for a safer center that's more desirable with less issues like tagging or vandalism or drugs or et cetera. And overall, it produces much higher rents and much happier tenants. But it costs money. And that's what you're seeing right here under security. You're gonna see some management fees. Oh my gosh, those are crazy. Yes, they are, but we use a best-in-class property manager. We use one of the top property managers in the country because we tried one of the little guys, we tried one of the medium guys, and we didn't get the service we wanted, so we just freaking pay for one of the best guys. So we're gonna scoot to the next page on the income statement, which is the final page for our concerns here. Now, what do you see? Here are the total operating expenses of $45,000. And you take the total operating expenses of $45,000 and you get an NOI of $49,165. Boom, there you go. So while the equation's simple for NOI, right? Income minus expenses equals NOI, you can see how complicated this can get on a property such as a retail property with CAMs, all these considerations from property management to taxes to legal to common area maintenance to vandalism to et cetera. So NOI can get very complex and can be many items on the spreadsheet and the income statement if you have a complicated property. So this property is one of the more complex in our portfolio for management. Let's jump over to an example that's much more simple. Just looking at these financials, I feel calmer already. The previous property was a retail center in a very busy city. There's tons of things going on. There's all kinds of construction across the street. There's very high density. There's tons of people coming to the center. There's homeless concerns. There's national credit tenants. There's mom and pop tenants. There's probably 20 tenants total. There's a huge parking lot with all kinds of people coming through. So the previous example was a busy foot traffic center that was retail in the middle of a busy market. Let's take a look at an industrial building with one tenant that's national credit. That's very simple, and the whole building's on CAMs. So you can get an idea of what NOI looks like and what an income statement looks like with two very different examples. Let's jump into it. The first thing you're gonna see here, while that other one was a whole bunch of pages and a whole bunch of line items, in 2 pages, you get the whole property. The whole property in 2 pages, look at that. Pretty remarkable, right? So let's jump in. Our first number, let's take a look at total rents, right? $30,000 a month in total rents. But when you add in the total expense reimbursements, you have some additions there for a total revenue of $44,000. Boom, we have our first number for NOI. Now let's find our expenses. Now we are in operating expenses. You can see taxes, you can see insurance, you can see utilities, you can see management fees are expensive. Again, we like best-in-class property management, and we only like working with the best, so we are willing to pay for the best. So guess what? We're already at the end of this whole party. You can see that the total operating expenses are $8,200, and that results in a net income of $36,000. So all that is taking 44,000 minus 8,000 equals 36,000. That's it. So essentially in a page and a half, we have an entire property story. What story is this telling us? That this is a simpler leasing situation. The operations on the property are much simpler from an ownership landlord perspective. The tenant's high quality and we don't have a lot of legal fees or a lot of maintenance fees or a lot of issues associated with it. Overall, this is a pretty smooth sailing property. All financials tell a story. And the story of the last two financials are very different. One is a crazy center with many tenants and many people in and out and just this busy retail neighborhood power center. And the other is a simple warehouse logistics distributor for Amazon that sends products across the region that it's located and has a more streamlined operation for the ownership. So I hope those two examples really helped you guys understand what exactly NOI is and what they look like on a property level. As a final review, I'm going to highlight the equation one more time in a different way so that you can see right here. Income generated from property minus operating expenses equals NOI. So that wraps up our discussion on NOI for today. And there are many more in the Real Estate Fundamentals playlist that we have on YouTube here. So check out those other videos. If we referenced any other videos, like let's say cap rate, etc., check the description below because we likely have links to those for those videos so you can go learn about all the other fundamentals that go into analyzing real estate and investing in real estate. If you found this video helpful, subscribe below. Check it out. We're going to have more coming up and we don't want you guys to miss it in your learning journey. Also, if you do me a favor and like this video, what it does is it circulates this to more people so they can also learn about real estate and we can grow this community with a lot of interested, like-minded people. Have a great day and I'll see you guys soon.